Yeah, Nvidia is a normie stock pick. I couldn't have said it better myself. That's honestly probably the right way to look at it. Not that normie stock picks are always bad, but it's a very unoriginal stock pick. And you're late to the party. The stock already went up a ton. And again, that doesn't mean it can't keep going up. It's just the thing about tech that's really important to understand, and tech investing and tech trading, is that value investing generally doesn't work that well. And the reason that is that as the tech company gains momentum, right? As that company does well or above expectations, the multiple, which is not a real thing if you've watched some of my videos, but the other ways the multiple manifests, the multiple concept, which, is things like, really at the end of the day, discount rate and long-term investor expectations, maturity rate, things like that, which all kind of people just condense into this the multiple concept. What ends up happening is investors, let's say Nvidia has a really good quarter next quarter, investors start to change those embedded expectations. So they'll kind of lower their mental discount rate, they'll increase their mental perpetuity or terminal growth rate, and they'll throw caution into the wind, basically, because the growth is looking good. And then the opposite will happen with multiple, what people on Wall Street stupidly call multiple compression. The same thing will happen. And again, those are dumb terms, but their shorthands conceptually are pretty good for what they are, which is this idea that investors will sort of change the way they look at the risk of the company, in essence. And that's something that'll change the valuation more than it maybe should. So if Nvidia does grow quite a bit, it'll quote-unquote grow into its valuation, as some people say sometimes. But the problem with that is that as an investor, you'll probably miss a double in the stock because tech stocks are that sort of sensitive to small changes. You might see sometimes a tech stock miss earnings by a penny or 1% on the revenue line, and the stock go down 30% or something, right? And that's because the embedded expectations of the investors are really what's the most important thing when you're trading tech stocks. And sometimes those are hard to know. You can kind of impute them from their valuations, but you also have to have your ear to the ground talking to other tech investors and getting a sense for kind of what the heck is going on in the market, which is a skill that most value investors don't care for. And there is value investing in tech, but you're generally buying sort of beat up stocks. Occasionally you can do value investing in buying growth stocks. But for me, I can go back to the Nvidia model in a minute. I'm missing something here, deferred taxes. All right, here we go. Yeah, let me go back to the Nvidia model from yesterday. So I'll give you an example here. If Nvidia can grow revenue for 30% for just a couple more years and then never grow again, it's a very cheap stock, right? But it's kind of silly to think, it's not that silly actually, but it's because it is possible. I'll extend it to 2030. So they stopped growing in 2028. They hit 100 billion in revenue, okay, and 50 billion in net income, which is just wild, right? No company is that profitable. We're going to discount at 8%. I guess we should probably do some reinvestment. Let's see. Is this fiscal 23? Yeah. Where's everything starting? So it's a fairly simple calculation, right? The value of any company is the sum of its cash flows over from today till infinity, right? Discounted by some percentage. And here we go. So that gives you 500 billion, which per share is at 156 now, so that's 202. So Nvidia would have to quadruple relatively quickly, right? 30% a year for the next 6 years, which I think Nvidia would be very happy with, right? The rate of growth for the last 6 years or so, let's see, has been 1, 2, 3, 4, 5, 6, right? %. So if they do 30%, their growth rate's accelerating, which is, take this, and this is really 7 years, isn't it? Isn't it? So it's even less. But I'm also, I'm cherry picking. I'm not cherry picking, but like if I do 8 years and pick this number, maybe it's better. So the Q8 of Q9 and P9. Okay, it's still 23. So it's all in the 20s. So I'm goosing it to 30, and I still get a stock price that's really not that much higher than where it's at. And somebody's asking, do I think this is realistic? I think that it's possible. GM means good morning, by the way, not General Motors. The point is that even if this came true, right, this is a really valuable exercise, you only get 30% upside, right? You only get 30% upside in the stock. So you'd have to have a pretty amazing run. Now look, they've had an amazing run, right? Look, the company went from 4 billion in revenue to 27 billion in revenue. Usually that kind of momentum doesn't just stop, right? It's a freight train going 60 miles an hour. It's not going to all of a sudden hit a wall, right? I think that a lot of the things that I didn't miss the boat on AMD, but anyway, the freight train isn't going to stop. All the things that are happening for Nvidia that's that has gone well for Nvidia, they're continuing to go well. They have this great management team, et cetera, et cetera. But you have this embedded expectation, right? The embedded expectation appears to be high 20s revenue growth rate, which is going to be very difficult to sustain. Doesn't mean they can't sustain it or even eclipse it, right? They could eclipse it. And again, my point is that let's say they get on track and they get back on track and they have a 30% growth year or even a 40% growth year. And they've had that before. Just last year they grew 60%. 60%. Right? But now they're going 0%. So they kind of probably spread some of this growth unevenly. So, the point I'm making is that let's say they do have this great year, you'll have all these embedded expectations shift a little, and the stock will jump. So remember, from the stock price, you can reverse engineer the embedded expectations, and vice versa. From your expectations, you can reverse engineer the stock price. But as stocks go up, they're kind of like a Ouija board of people sort of pulling and pushing on with their supply and demand, and they arrive at an answer that sort of gives you the market sort of feel of everything in one, and you just have to sort of think about that intelligently, right? You can't be dogmatic in any way. If the market's going up, you have to assume the market is smarter than you, and the market's thinking something you're not thinking, and be open-minded. Then, of course, you have to trust your own analysis too. So it's difficult. you know, again, the best thing is to really understand the space, and the space here is convoluted. You know, it's not clear what's going to happen. It looks like their omniverse, metaverse stuff isn't going to go well, but you know, these data centers, I use these data center products like GCP, AWS, and Azure every day. They're, you know, I don't see that slowing down anytime soon, and they really have almost no competition on the GPU side. Will that change? Sure. But it seems like a really smart management team that's ahead of the curve on everything. And we can clearly see a tech-powered world for the future. But again, they hit $100 billion in revenue. Again, the average person would say, okay, if a couple of years go by and they do that, this stock will be a $600 or $700 or $800 billion stock. So, you know, it's a tricky thing to do these. If you need more background, like basic information on some of this stuff, I would look at Aswath the Matarand's website. He's probably the best academic finance teacher. And he has a number of, he's over here at Stern, NYU. And his website's been, you know, a pretty good valuation tool. Tons of different lessons and spreadsheets and things on here. I think if you need a valuation primer, this is a little. These concepts are fairly advanced. You know, it doesn't take much to learn how to do a DCF model. It's fairly easy. It's not easy to sort of understand embedded market expectations and interpreting them correctly. And it's very, very hard to understand the behavior of tech stocks. You need a lot of experience, and it's difficult. You know, it's something that comes with time. You know, again, you know, understanding scientifically why you get this weird phenomenon where a small earnings beat will lead to a very large stock price reaction. It really comes from some of these things, right? So like, let me see here. If a discount rate drops 50 basis points, right? And how does one viscerally feel the difference between the 7.5% discount rate and an 8% discount rate or a 9% discount rate or whatever it is? Notice Aswath's site said that ERP, equity risk premium, which discount rate is constructed from, is about 5% right now. The consumer market has dropped for Nvidia quite a bit, so they're down 50% year over year, which was shocking to me on the gaming side. But the data center side is the growing business. I use Google Sheets sometimes too. It's a good product. It's got sort of better programmability than Excel, but doesn't, you know, they're all the same, dude. So everyone asks me about ChatGPT every day. ChatGPT and transformer sort of neural networks have been around for a really long time, several years now. They're not new. I was playing on GPT-2 when it came out. I was playing on GPT-3 in prison. GPT-4 is almost here. I just opened up an API. API key, so I'm going to probably integrate that into some of my products soon. So it's an important, special new product. Obviously, I've talked about this in my prison blog, which I don't think is around anymore, but I can dig up the old things. But I talked about how important it is 6 months ago or so. So nothing new to me, at least. It's obviously gotten a big media push lately, so everyone's thinking about it and talking about it and asking about it. But it's definitely not new technology. Large language models have been talked about for a while.